Right, it's 1 o'clock and time for the Wall Street Crossover Show, sponsored by Admiral Markets and with their market commentator, Darren Sinden.
Afternoon, Zach.
Right, we're on the edge of our seats, aren't we?
Here we are. We thought the September's non-farm payrolls number was the biggie. We were wrong. It turns out that October's is the...
Is it really bigger, or is it just...
Well,
it just feels like
it's the focus, isn't it? I mean, you know, it's part of a pattern. It's the last but one for 2016. Yellen's hinted that there could yet be a rate rise in December, and you know the market says a 58% chance of that now. So it just takes on extra significance.
So that's the Yellen's made it more important than it probably would have been.
Absolutely,
so,
yeah. Because
it's not that there's still one more to go. All right, let's go on to the slides and the information you've gathered.
Okay, well, we've got a couple of interesting data points today that we saw in Europe. First of all, to France and their trade balance. Came in at a negative 3.38 billion euros. That was around 0.28 sort of a billion, I should say, above the forecast of 3.10 and significantly above the prior read of minus 2.98 billion. So the woes of the French economy continue, but it's not the bad news anyway. It's not just confined to France. We had German industrial production numbers from September. We look at the month-on-month figure here, came in at minus 1.1%. The forecast had been for plus 0.5% against the prior minus 0.6%. And you'll recall that we had some poor German factory orders data.
So this is a bit of a falling off a cliff situation, isn't it?
It is really, and you had the European Commission forecast for economic growth for next year, talking about modest and continued growth in the Eurozone. Well, numbers like that would tend to tell a different story, so remains to be seen what will happen there. And then if we look forward to next week, relatively quiet as far as the US calendar is concerned, but Europe has a bit more meat on the bone, shall we say. We've got China's trade balance numbers being released on Sunday. That's the numbers for October. Obviously, people will be watching those closely because we saw a sharp drop, sort of north of 20% drop in exports last month. So, you know, they'll be eyed keenly. Then coming into the trading week proper, we have the British Retail Consortium retail sales numbers for the UK from October. They're released on Tuesday. Also on Tuesday, we have French and Italian industrial output numbers. So again, that will shine some light on the underlying health of the industrial economy in Europe. A number that people watch quite closely comes out on Wednesday, China urban investment. This is one of the numbers that makes up many of the baskets of data that people use to try and make a judgment about what the real GDP growth is in China. So the quants will be studying that very closely. And then we come back to the UK for unemployment data for September. Obviously, Mr. Carney, who said to the press yesterday that they will prepare for a rate rise in 2016. We'll be watching that number closely. And then on Thursday, inflation data from Germany. We've got a whole raft of numbers there, and that will be very interesting indeed to see just how well the ECB is managing to stimulate inflation in the German market.
But tipping in the Eurozone towards almost dead certain action needs to be taken by the end of the year.
Oh, I think it's almost inevitable, yeah. Right. They'll do something extra, yeah.
Let's go on to the stocks, the European movers.
Okay, we start in Switzerland with Richemont, the purveyor of luxury goods. That's ticker CFR on the Swiss market. 79 francs 70 trading this morning, down around 8%. The company posted mixed numbers today. The CEO of their Cartier division is to step down due to ill health. The company said it saw a challenging second half of 2015. To give you an example of that, watch sales, for instance, to Hong Kong slumped by 20.5% in the first 9 months of the year. So tough times. People are not spending. Chinese people in particular are not spending.
The discretionary side has just gone out the window, hasn't it?
Yeah, it has. Yeah, you know, they're tightening their belt, travelling abroad less and spending less money when they do, and that's Richemont are one of the first people to feel that. And then we slip over the border into France to look at Sanofi. That's ticker SAN in Paris. €87.74, down around 5.94%. And the company effectively posted a profits warning this morning when it warned that it didn't expect to make any meaningful profit growth for the next 2 years. And that's despite plans to bring 18 new products to the market. The company is in a bit of a transition, and it will undergo significant restructuring under the relatively new CEO, Oliver Bradcourt, for a kick-off. I think he wants to try and sell its generics business. But it's very hard to please the market if you're a pharmaceutical company at the moment. They're a very hard bunch to please.
That sounds rather ominous, really. A 5%, 6% fall in the share price is quite lucky, really.
I think they are, really, when you think about what's happened to things like Valiant in the US. But yes, 6% down, and looks
nothing to look forward to for the next 2 years. Doesn't seem to be very good.
It doesn't. No.
Right, let's go on to the M&A rumours and movers.
Okay, well, we're revisiting a name that we've touched on several times over the summer, Syngenta, the Swiss agri-chemicals business. That's ticker SYNN in Switzerland. And they're said now to be in talks with both DuPont, double D in the US, and Dow Chemical, nice simple ticker there, Dow, about combining their agricultural business divisions. All three of these companies have a big presence in the pesticide and insecticide market, as well as the seed business. The talks have come about after their rival Monsanto abandoned its pursuit of Syngenta back in August. But that deal might now have backfired, or they're not pursuing that deal, rather, might now have backfired on Monsanto, as a combined agri-business between the three groups would be much stiffer competition for Monsanto. At the same time, however, possibly would face some antitrust concerns in the US, so not necessarily a done deal even if they could agree terms. In terms of a bit of background, DuPont has a new interim CEO, and he may be keen to do a deal to show his worth, but to try and secure that job full time. And Dow Chemical openly acknowledged a month ago that talks are ongoing between major players in the space. Syngenta, of course, for its part, is seeking a boost after fighting off that Monsanto bid, but then seeing its share price fall very sharply after the bid premium went away. So lots of this is being driven by mounting cost pressures. Farm incomes in the US are under a great deal of pressure. I think they're down 36% year to date, and they could fall to the lowest levels for a decade in 2015. So that's obviously placing pressure on suppliers to the farming industry, and they're being pressured to consolidate or spin off certain divisions. There are two activist investors, one at DuPont and one at Dow Chemical. I think it's Trian and Third Point are the two activist investors, and they're keen to get those businesses out the door as well. So something probably will happen here, some combination of those three, if not all three together.
It's all in play at the moment.
Absolutely, so watch this space.
Okay, well, next up we've got the data points.
Well, all roads lead to 130 and the non-farm payrolls for October. Consensus is between 185 and 190,000 new jobs versus the prior read of 142,000 for the payrolls.
I do not see how it's going to get anywhere near that.
No, well, we've seen two big misses in the last data. You know, I think 60,000 odd and 40 odd thousand in the last two numbers. They just watch out for possible revisions actually to those prior numbers. And then in terms of the unemployment rate, the expectation is for a small move down, so to 5% from the prior 5.1. We'll see what we get in about 25 minutes
Below
time.
5% would be just totally interest rate rise city, wouldn't it?
Yes, if we saw 4.9 or 4.8, I think that would be a done deal. And even though maybe it's not the right thing from my point of view, I think that would force the Fed's hand.
Yep.
So if we look out to next week, as I said, it's a relatively thin calendar in the US. Wholesale trade numbers on Tuesday alongside import prices. On Thursday, of course, our old friend, the weekly jobless report comes back. Probably the most important data of the week is on Friday next week with PPI and also retail sales being released. So we've got a relatively light schedule in the afternoons next week.
Okay, well, let's go for the pre-market movers and levels.
Okay, well, we start with TripAdvisor, that's ticker TRIP or TRIP in the US, $75.60, down just over 9%, and they managed to upset the market on almost every level. They missed on Q3 earnings, and they guided lower on 2015 revenue growth, and they guided below both the prior guidance they'd given and the market estimates. So they didn't win any friends.
All over the place.
Yeah, absolutely. And then we move down to Tableau Software, people who make data management software. Data is the ticker there, handily, $100.78. They trade pre-market up a whopping 19.4%, and they showed how it should be done. They beat Q3 estimates. They guided higher, and the market believes that guidance might still be conservative. They posted a 57% rise in license growth after a 60% rise in the same number in the prior call. So we've talked about some software companies who are struggling to move to a licensing model. Obviously, Tableau are not having those problems in the market.
It's all about data, isn't it, now?
Yeah, I mean, yeah, it's a great service. If you haven't used it and you've got data to try and visualise, it's well worth having a look at that, I think.
Okay, all right, let's go on to the levels to watch.
Okay, so in the cash equities for the FTSE, we look at 63.50 on the downside, plays 63.90. Most things are in a tight range today ahead of the non-farm numbers. For the DAX, we look at 10,815 on the downside, plays the round number at 10,900. And for the S&P, 2090 on the downside, that should say 2110 to the upside. My apologies for the typo. And for the Dow, 17,860 on the downside, plays 17,930 to the upside. Currency-wise, the feature this week really has been, well, particularly the European currencies, how they've weakened against the dollar. So for the euro now, though it's bounced back slightly from midweek, 108.43 on the downside, plays 108.95 to the upside. The Aussie US dollar, 71.40 now on the downside, plays 71.70, so quite a tight range there by recent standards. Dollar yen sort of sat the week out really, but the yen has eased slightly, 121.60 to the downside, 122.35 the level to watch to the upside. But it's cable that's had the most significant move really. We started the week with a 154 handle. We now look at 151.23 to the downside, plays 151.90 to the upside.
Yes, a shock move there from the Bank of England to weaken sterling. In focus.
Okay, well, we're staying with what we're watching here, key US data ahead of the Fed's December meeting. And of course, it's the unemployment rate and the non-farm payrolls that will hold our attention today. So as we've said already, that the unemployment data may well hold the key to the next move in US interest rates. Whilst unemployment has been falling, though, so has the rate of job creation. And just here on the chart, job creation on non-farm payrolls here in blue, the unemployment rate, the dotted grey line. Just to reiterate that the point that Goldman Sachs is forecasting a much slower rate of job creation next year, so they're looking for around 85,000 jobs per month on average over 2016. So if we don't get data to support a rate move today, we may not get it. The Fed may miss the window of opportunity. As we've already said, today's non-farm number is forecast at 190,000, though again some commentators are suggesting that any number above 140,000 would be good enough to keep the Fed on course for a December rate rise. However, a number lower than that would certainly give them pause for thought. So yeah,
the window is shrinking by the day.
It could be because if you don't do it by December and then you're looking for labour market tightness, 85,000 jobs a month next year, is that good enough? Probably not. No.
Okay, well, on that intriguing note, Darren Sinden, thanks for the Wall Street crossover show today. You're from Admiral Markets, the market commentator. We'll be back on Monday when all will have been revealed, I presume.